Hello, this is John Eade, and I am Director of Portfolio Strategy at Argus Research Company. Argus Research is an independent investment research firm based in New York and London. Today, I'm going to talk about a topic that has been very popular with our clients recently, and that is dividend investing. So I want to first of all talk about the importance of dividends among investments and investment return. Some years the stock market doesn't rise at all, and the only way that investors get a return is through a dividend. We saw that most recently in 2018 when stocks in the US were actually down. So the only income you got was from your dividend. Typically, in the past 10 years, dividends have accounted for 15 to 20% of total stock returns. And that's a bit of a shift from the long-term record when we've seen dividends account for as much as, or on average, 40% of total returns. So dividends are an important part of returns for equity investors. But not all dividends are created equal. I'm thinking about two different types of dividend stocks. One is the high yield group, and the other is the dividend growth group. Now, the high yield group might pay a higher dividend rate. However, that yield anywhere, really anything north of 6 or 7% is probably at risk of being cut. A company might have to cut its dividend if business is not going very well, and that's often reflected in a lower price. So if you see a yield of around 7 or 8%, take a very close look at the financial strength of the company. They might not be able to support that dividend. And in any event, in a market environment where interest rates are rising, investors are likely to sell out of those high yield stocks and into safer and securer bonds. So we don't like the high yield part of the dividend market here. Rather, we're focusing on dividend growth with maybe dividend yields around 1 to 3%. Your income isn't going to be as high, but your returns are probably going to be more consistent over time. So if we're focused on dividend growth, what kind of dividend growth should you look for? The average dividend growth per year going back to 1970 is just over 2%. And really in only 5 of the past 40 years have dividends on average been raised at least 10%. But that's what we look for. We look for that double-digit dividend growth as an important signal from a company about the prospects of the company. We actually think double-digit dividend growth sends 3 signals about a company. 1, the company's got a strong enough balance sheet to support a dividend. And to make that determination, we look at debt levels, fixed cost coverage, dividend payout ratios, and earnings quality. 2, management is aware that dividends are an important component of shareholder returns, and management is very focused on delivering returns to shareholders, which we think is another positive sign. And 3, if a company is increasing its dividend at least 10% a year, typically over the past 5 years, then that management team is signaling to the market they're pretty confident about their near-term outlook, which is somewhat rare amid a pandemic and the global recession we've been going through. So at Argus Research, we're focused on dividend growth, not high yield, on companies that are growing their dividends at least 10% a year, because we think that sends those 3 important signals, the most important one being management is confident about its near-term outlook. Thank you very much.